The US just went to war with Iran, and the Strait of Hormuz, where 20% of the world's oil passes through, is shut down. 150 tankers are sitting outside, going nowhere. And there's one stock that was built for exactly this moment. Alright, if you're short on time, or if you just refuse to listen to a random cat on the internet, totally fair. Here's what you need to know. When a major shipping lane shuts down, oil doesn't stop being needed. It just becomes harder to move. Harder to move means ships are busier, routes get longer, and the companies that own those ships can charge more, a lot more. Frontline is one of the largest tanker companies in the world, and right now their ships are earning over 4 times what it costs to operate them. Every single day that this conflict continues, that gap keeps printing cash. We first covered this stock back in December. It's up 70 to 80% since then. And after their latest earnings report, the numbers suggest this might just be getting started. Now, if you want to understand the full picture, the earnings, the fleet, the math behind why this setup is so unusual, and honestly, what could go wrong, that's what the rest of this video is for. You don't need a finance degree to understand that math. You just need to understand that when it costs you $24,000 to run a ship and someone's paying you $107,000, every single day is a money printer. Now, if you want to understand why this is happening, whether it can last, and what could break it, stick around. Hey, I'm DataCat. So for those of you who are new here, and honestly most of you probably are because this channel is like, 7 months old now? I used to be an analyst at a Fortune 50 company. Messy data, iterations of useless models, daily stand-up meetings, those kind of things. Traded that life for, this not exactly the career pivot my parents or my cat envisioned, but here we are. I started this channel because I genuinely enjoy breaking down financial data, and I figured, maybe someone out there would find it useful. I'm not here to sell you a course. I'm not here to tell you I've got some secret formula. I'm just a guy who likes digging into numbers and talking about what I find. So, if any of that sounds like your kind of thing, a like and subscribe would genuinely mean a lot. It helps the channel more than you'd think, especially at this size. Okay, enough with self-promotion. Let's get into it. So some of you might remember back in December we covered Frontline for the first time during the Venezuela incident. The thesis back then was pretty straightforward. This is a company built to thrive on chaos. Geopolitical disruption tightens shipping lanes, tightens tanker supply, and Frontline, with its modern compliant fleet, meeting perhaps one of the most chaotic US presidents in history, sits right in the sweet spot. And since then, the entire energy sector has had a good run. But Frontline specifically, 70 to 80% gains. About 30% of that came in February alone. So clearly something is working. And now we've got 2 new catalysts landing at the same time. First, Q4 2025 earnings just dropped, and the numbers are, we'll get to that. Second, the big one, the US and Israel launched a coordinated strike campaign against Iran. The Iran leader was killed in the strikes, along with dozens of senior military and intelligence leaders. Iran formed an interim leadership council. They retaliated with massive missile and drone strikes on US bases across the Gulf, hitting Israel, the UAE, Bahrain, Kuwait, and Qatar. There are civilian casualties across the region. Meanwhile, Trump has said the war could last 4 weeks and has called for Iranian regime change. Now, I want to be clear. Look, as much as I'd love to see a totalitarian regime collapse, we can't ignore the fact that behind every headline about collateral damage, those are real people, real lives. So while we're here to break down the investment side of this, I don't want to just gloss over that. Even if you might be celebrating at the moment, let's just pray that the people caught in the middle of this would make it through. That's all. Alright. With that said, as investors, our job is to understand what's happening and position accordingly. And what's happening right now in the tanker market is frankly extraordinary. So let's break it down. So here's what you need to understand, and this is the part that most people covering this conflict are getting wrong. They're focused on oil prices. Oil up, energy stocks up. That's the surface level take. For tankers, the question isn't really whether oil goes up or down. It's 2 things. Are barrels still moving, and how hard is it to move them? Right now, the Strait of Hormuz is effectively closed. The IRGC has warned vessels that no ships are allowed to pass. There are roughly 150 tankers anchored outside, just sitting there. Think about that for a second. 150 tankers doing nothing. That's supply being removed from the market in real time. But even beyond the full closure, there are layers of friction that tighten things up. You've got war risk insurance premiums spiking, ship owners getting more cautious, refusing certain routes, convoying and delays eating up ship days. Every one of those factors means fewer available vessels for the same amount of cargo. Then there's the ton-mile effect. If Middle Eastern oil flows get disrupted and buyers have to source from, say, the Atlantic Basin instead, those are longer voyages. Same barrels, more ship days consumed. That's pure demand creation for tankers without a single extra barrel of oil being produced. And here's the layer that specifically benefits Frontline. In a heightened sanctions and security environment, charterers pay a premium for modern, reputable, compliant tonnage with clean histories. They don't want to touch the dark fleet, the grey fleet, the sketchy stuff. They want ships like Frontline's. That compliance premium widens, and Frontline is on the right side of that gap. It's like, you know how cats always land on their feet? Frontline is the cat of the tanker world. Chaos everywhere, and somehow they're just landing perfectly. Every time. Alright, so let's talk about what Frontline actually is as a company, because the earnings call gave us a really clean picture. Their fleet: 41 VLCCs, 21 Suezmaxes, 18 LR2s. Average age about 7.5 years. That's young. That matters because younger ships are more fuel efficient, more desirable to charterers, and face less regulatory risk. The entire fleet is eco-spec. 57% are scrubber-fitted, which means they can burn cheaper fuel and pocket the spread. Management describes Frontline as a high beta instrument on spot tanker economics, and I think it's actually the truth. Their golden rule on coverage is they're comfortable hedging up to about 30% of their fleet on time charters in certain conditions, but they won't fully hedge away the upside. They want exposure to spot rates. That's the whole point. Now here's where the Q4 numbers get really compelling. For Q1 2026, they've already booked a significant chunk of their days at strong rates. VLCCs, 92% of days booked at over $107,000 per day. Suezmaxes, 83% booked at over $76,000. LR2s and Aframaxes, 67% booked at over $62,000. In this kind of business, this is rather important because it takes a lot of the guesswork out. We're not sitting here going, well, if rates do this, maybe they earn that. No. A huge portion of near-term earnings is already locked in. It's visible, it's real. And then you look at the break-even. Fleet average cash break-even over the next 12 months, approximately $24,000 per day, VLCCs around $25,000, Suezmaxes around $23,700, LR2s around $23,800. So when VLCCs are printing $107,000 against a break-even of $25,000, every single day of operation is generating over $82,000 of cash margin per ship, per day. You can pull out the calculator and multiply that across 41 VLCCs and then add the Suezmaxes and LR2s on top. What I'm trying to say is, that's not a stock. That's a toll booth on the ocean. A toll booth that a very angry cat is guarding. And the toll just went up. So, Frontline provides this metric they call cash generation potential. And when you first see the number, your brain kind of rejects it, I'll be honest, because mine did too. As of February 27th spot rates, $2.8 billion total, or $12.51 per share. They frame that as a 34% cash flow yield on the stock price at the time. And then they give you sensitivities. If spot rates go up 30% from that snapshot, it becomes $3.7 billion, or $16.84 per share. If rates drop 30%, it's still $1.8 billion, or $8.19 per share. Now you may be wondering, how should you think about this? It's an annualized snapshot. It's saying if the current rate environment just persisted, this is the cash the fleet would generate over 12 months. It's not a guarantee, it's not a promise, but it's a mathematical output of the current conditions. The reason the number is so large is structural. You take very high TCEs, subtract a very low break-even, and multiply across a massive number of earnings days. 27,700 annually, with about 24,400 spot days over the next 12 months. When you have tens of thousands of earnings days, rate shifts compound fast. $1,000 per day improvement across the fleet isn't a rounding error. It's millions of dollars of incremental cash. And this is exactly where the war dynamics plug in. The conflict doesn't need to raise oil demand for Frontline to benefit. It just needs to increase friction in seaborne logistics or widen the premium on compliant tonnage. Higher war risk, more delays, fewer effective ship days available, TCEs go up, cash generation jumps. Route dislocations create more ton miles, more vessel demand. The compliance premium widens. Frontline's modern fleet clears at better economics. If war dynamics push realized rates toward that plus 30% scenario, you're looking at $16.84 per share of cash generation potential on a stock that, let's just say, the market is still skeptical about. So you might be wondering, if the math is this obvious, why isn't the stock at the moon already? Well, to be fair, it kinda already have, just not the tech stock explosion we'd normally see. So is there still room to move up? Let's be clear. Tanker equities have this reputation problem. They always look cheap on spot cash metrics because the market has been burned before. The assumption is always some combination of rates will mean revert, summer seasonality will soften things. Management themselves expects a summer lull, by the way. And if the conflict actually reduces physical export volumes for long enough, that could eventually reduce demand for ships, even if rates spike initially. That last point is the real bear case, and I want to be honest about it, because I'm not here to be your cheering cat. If this war leads to a sustained material reduction in key export volumes, if barrels just stop moving, that overwhelms any friction premium. Fewer barrels, fewer ships needed, period. The other scenario that breaks the thesis is rapid de-escalation. If this conflict resolves quickly, war risk premiums collapse, rates mean revert fast, and the elevated cash generation window slams shut. And of course there's China. Management explicitly flagged import slowdowns and inventory behavior as a volatility trigger. If Chinese importers decide to throttle purchases or draw down inventories instead of buying spot cargoes, that's a demand hit. So the thesis is not, Frontline will earn $12 to $17 per share every year forever. That would be a fantasy. The thesis is, Frontline is positioned to print extreme cash in the current regime, and the equity can re-rate while that regime persists, especially if war conditions extend the tightness window beyond what the market is pricing in. You know, it's kind of like a cat staring at a bird through a window. The opportunity is right there, obvious, visible, but the cat, in this case the market, keeps hesitating, not sure if the window is actually open. Meanwhile, Frontline is already outside catching birds. Alright, so if you're watching this stock or already in it, here's what you should be monitoring to know whether the thesis is playing out. First, war risk and insurance conditions. Not just is the strait open or closed, but how are ship owners actually behaving? Are they avoiding routes? Are insurance costs making certain voyages uneconomical? Availability matters as much as headlines. Second, the rate indices and the FFA curve. Are VLCC, Suezmax, and LR2 rates spiking briefly and fading, or are we seeing a sustained elevated regime? The shape of the forward curve tells you what the market expects. Third, fixture counts and port congestion. If you see waiting times increasing and fixture activity staying strong, that's tightness. If fixture counts are dropping, that might signal a volume collapse, which is the bear case. Fourth, time charter appetite at elevated levels. If charterers are locking in ships on time, charters at high rates, that tells you the market believes tightness will persist. That's a strong signal. So look, this is a fluid situation. The conflict is literally days old. Hezbollah just entered today. Things can change fast in either direction. But the setup for Frontline right now is about as good as it gets for a spot-exposed tanker company. Low break-evens, modern fleet, strong bookings already in hand, and a geopolitical environment that is systematically tightening the supply of compliant tonnage. We've been on this stock since December. The thesis was chaos benefits Frontline. So far, that's played out. We'll keep watching. If you found this useful, a like and subscribe genuinely helps. This channel is still tiny and everyone counts. And if you think I got something wrong, leave a comment. I'd rather be corrected than be wrong in silence. Alright, that's it for today. DataCat out, and I'll see you in the next